Hey, what's going on? In this video, we're going to discuss using debt to buy real estate and paying no taxes. Isn't that what we would all like? I mean, think about it. Some people think otherwise though. They want to pay their taxes, and I get that. You want to make sure that the police department have money, churches and schools, and we have roads and good parks. And some people may make the argument that the government don't know how to use the money that we pay the government for taxes. I digress. This video though will discuss the loopholes that the government has put in place for every living person that live in America. And I'm here to use those loopholes. That's all I'm saying. We're going to use them. In this video, we're going to discuss 3 core concepts on how to use debt with buying real estate and how to avoid paying taxes. We're going to discuss how to use debt really efficient. If you don't know how to avoid paying taxes, buying real estate, then this video is for you. If you don't know what entity to get into to avoid paying taxes, this video will help you do just that. This video will help you tap into your home equity line without paying taxes, which is really easy to do. I'm going to show you how to do that. Really simple. And by the way, every single real estate investor that's successful in this particular lifetime have utilized these basic fundamental strategies that we can all use. It's no race thing, it's no culture thing, it's no female, male, or whatever gender you are thing. This is just a rule or laws that are in place to help advance the American culture. And look, if you stay around to the end, there's one strategy that a lot of different real estate investors use to buy multiple properties in a quicker span of time using debt versus using cash. So let's get right into it. But before we get right into it, hit the subscribe and like button to get more content just like this, so we can continue to bring you great content every single week. Number 1, the most important thing you got to look at is whether or not your house that you have, or let's say you have a house that's your primary residence. Now, with a primary residence, and let's say you sell the house with this primary residence. A primary residence is a place where you lived in, and now you want to sell the house and you have some capital gains, you have some profit. Now with that profit, the government says up to $250,000 for a single person, you can avoid paying the capital gains tax. However, if it's above $250,000 as a single person, then you have to pay the capital gains tax above the $250,000. Now, if you're married, you can avoid paying the capital gains tax up to $500,000. That's a lot of money. Now, if it's above that $500,000 mark, you still have to pay taxes above that $500,000 mark. Not bad. Something to look into. Now, what is a 1031 tax deferred exchange? Well, what is it? So essentially what happens is that, let's say you have a house that's not your primary residence. It's under an LLC. And you sell the house and you have profits, right? So the government says, look, here's what we'll do for you. Since you have profits of, let's say, $500,000, you can put it into a 1031 tax exchange account, which your lawyer can set up for you. Relatively easy to do. And it says, look, if you invest this $500,000 into another asset, into an investment asset, then we will defer the taxes. It's not saying that you do not have to pay the taxes, but you can defer the taxes as long as you like. However, the moment you decide to sell the house or to sell your investments and put that money into your personal bank account, then you're liable to pay the tax rate. Now, oftentimes what's happened is that nobody never does that. Nobody's doing that. So a 1031 tax exchange, it defers the taxes. Now, let's say, going into my second point, if it's not a primary residence, the house itself has to be some sort of entity, preferably an LLC, which is a limited liability corporation. Now, within this limited liability corporation, the house itself or the investment itself goes into that. Once you are able to sell the house, you take a profit, you put it in a 1031 tax exchange account. There are guidelines. The guideline says you have to have bought a house within a certain time frame. Sometimes that time frame can be 6 months. Now, sometimes, in most cases, the government always allows some sort of grace period. So they'll allow you to extend it past that 6 month period, sometimes to 7 months, 8 months, 9 months, 10 months, sometimes even a year, because sometimes negotiations can last a long time. But as long as you've identified an investment within 6 months, then you can get your taxes deferred. If it's not within that 6 month period, then you may be liable to pay taxes. Simple as that. Number 3, there's another way to really avoid paying taxes from the equity that's in your house. Now, let's say if you tell yourself, look, I really don't want to sell my house. I really want to keep the house. I just want to get some of the money that's out of the house. Now, another way you can go about doing this is to refinance. Now, what is refinancing about? Well, refinancing is essentially going to a banker and having them look at the market value of your house and assessing how much equity you have in your house. Let's say you have $300,000 of equity in your house. The banker will give you a loan on that $300,000. So essentially, you get $300,000 in your cash. Essentially, you get $300,000 of cash in your bank account. And with this cash, you can use this money for whatever you want to use it for. You can go shopping. You can buy yourself Gucci, Louis. By the way, don't do that. But anyway, most people use that money to buy another house. Okay, now the downfall to this is that your mortgage payments will be higher, meaning that every single month you're going to pay a higher bill. All right, so be very careful and be cautious on how much debt you're taking against your house. And also, it adds more risk if this is your primary residence. So understand that as you take out this house. Now, if you're able to find a really good deal, let's say you spend that $300,000 for a home that's worth $1 million, it's going to give you excessive cash flow, then it's a good deal. But if it's not that type of deal, then just be careful. And lastly, with refinancing to get out of paying taxes on the money, you can also, instead of refinancing, take out a line of credit. Banks all the time gives out a line of credit based on the equity that's in your house. So a banker will say, okay, you have $300,000 of equity in your house. I can give you a line of credit of $200,000. So essentially, you have a credit card, and in some cases, the credit card interest rate is lower than the interest rate of bank loans. So it's something to be watchful of. I would look at both options before making a decision. Now, lastly, like I said, I'm gonna give you the bonus here. Let's say you have $500,000 in cash and you're looking to buy an investment. You see this beautiful investment of $500,000. You're like, man, I could just buy the house or buy this investment with this $500,000. My profit is going to be 30%, meaning that I'm going to make 30% more on top of the $500,000. It's a great investment. I make $150,000 cash by investing $500,000. Not bad. Now, the second way to really look at this is to break that $500,000 into 5 different buckets, right? And with that, you can invest. You can find five $500,000 investments and 30% profit in each particular bucket. How much money is that? Well, over those 5 deals, you would have made $750,000 if all things hold true. Now, it is very difficult to find 5 deals to yield you 30% profit. Every deal is different, and I get that. But it's more so about the mentality that you got to have when investing in real estate. So, with that being said, you would have made potentially $600,000 more with the second option versus the first option. So it's something to consider. Now, with that being said, don't get too ambitious. Never spend the whole $500,000 to find or to buy 5 deals at one time. You may want to do 1 or 2 deals, pocket some cash. Don't get too ambitious. Pace yourself properly. Make sure you know the skill sets needed to develop real estate, to renovate real estate, understand the financing process, understand how things work before you just use all your cash. But in any event, thank you for watching. And if you like this video, I have another video which will explain to you the 3 biggest failures not to make when investing in real estate. Until the next time, peace. Peace.